Assalamu alaikum. Welcome to lecture 33 of SBR, which is IFRS 10. This is the continuation of lecture 32. In lecture 32, I discussed part 1 of the consolidated financial statement, and this is the part 2. This is the last part in IFRS 10. There are only two videos, part 1 and 2. So this is the continuation of it, and before you watch this, I request you to go back and watch my lecture 32. Okay, to get a clear understanding of IFRS 10, because that was the introduction, that was the all the basics and the introduction was explained in IFRS 10. This is into more advanced level. Okay, in IFRS 10, the first part we went through the basic group. Now in this lecture we are going to continue with the changes in the group. What happens when you dispose and when you acquire, how you are going to account for it in the consolidated financial statement. This is the focus of this lecture. So when you acquire a subsidiary, when you dispose a subsidiary, when control to control scenarios, that means even if you're acquiring or you're disposing, you're not losing the control or you're not gaining a control. Okay. Subsidiaries that are acquired with a view to resell, how do you deal with it? Then disposal of an associate, group reorganization. So these are the areas that we are going to cover in this. Okay, so let's start with the acquisition of a subsidiary. Now there are two scenarios that you need to understand. See, it's not that we always buy a subsidiary at the first, in the beginning of the accounting period, and we normally account it for 12 months. Sometimes what happens, we might acquire it in the mid-year. Okay, so if that's the case, we have to proportion. Let's say we have acquired it let's say the subsidiary was there for 6 months, so you already have to apportion all your income, assets, liability, everything for 6 months, right? All your income and expenses for 6 months only you have to take. Next is step acquisition. Step acquisition means when you are acquiring the control, okay, in steps. Same way we have step disposal also. Okay, so please understand the acquisition part very well. I will go a little slow here because in the disposal part I will be going quick. Why? Because disposal is just the opposite of acquisition. Everything you are studying in acquisition is the same for disposal, with only the opposite effect. If something is increasing in acquisition and disposal is decreasing, that's the only thing. Otherwise both are same. They are like a mirror. Okay, so starting with mid-year acquisition. Okay, a parent entity consolidates a subsidiary from the date that it achieves control. Remember, from the date you have achieved the control only you can consolidate. If it's for 4 months, 6 months, 5 months, it could be for any number of months. We are going to do a question shortly. Next, if this happens pathway, okay, you have to prorate. You have to prorate all your income and expenses in your group statement of profit and loss. Okay, now before we move on to the step acquisition, we are going to do the questions for a mid-year acquisition. So let's do that. Illustration 1. This is a example of a mid-year acquisition. Okay, and here you are required to prepare a consolidated statement of profit and loss. But in your exam, you will not be asked to prepare a full consolidated statement of profit and loss. You might only be asked to prepare extracts and explain the figure. Okay, but since this is a first question in a mid-year question, so this is a very good question to start with. Okay, so let's do that. First, let's see. So they have purchased 1.6 million of the 2 million equity shares, okay, for 10.28 million. At the date of acquisition, the retained earnings was 6.15 million. You have been given the statement of profit and loss. Okay, now let us read the other information. There were no other items of comprehensive income. Okay, now, so the fair value of net asset were equal to their carrying value except plant and equipment, which had a carrying amount of 2 million. Fair value was 5.2 million for the plant. Remaining useful life was 4 years. Depreciation is charged on cost of sales. Is charged to the cost of sales. That means in your cost of sales you have depreciation also. Okay, and it's time apportioned on a monthly basis. Second, during the post acquisition, Tudor sold goods to vendor. Okay, Tudor is the parent. Parent is selling to subsidiary for 12 million. Goods had originally cost 9 million. Okay, during the remaining months of the year, Visitor sold 10 million. Okay, of this goes to third parties for 13 million. Income and expenses are quite evenly throughout the year. 4. They have a policy of measuring NCI at full goodwill method. That is fair value. Fair value is this. Then recoverable amount is 14.15 million. Any goodwill impairment should be charged to admin expenses. Okay. So now, how do you start? When you are asked to prepare consolidated, we know we start with the revenue, right? So we can quickly start with the what? Revenue, right? Just okay. So now, or see here, you have a way to do this. You can immediately start with the revenue, cost of sales, and all those things one by one, and then go back and forth to working and the main, or directly go to working, finish all your workings, and then come to the main table and do it. Well, I have a habit of doing first finishing all the workings and then coming to the main table and doing the consolidation, because consolidating is easy if you know the figure. It's just adding all the figure and then writing it. But I don't prefer going back and forth to workings and the main table because it's quite of confusing also. So I better finish all the workings first. It's your choice. You can do it in any way. You can do this in Excel. Okay, I better finish all the workings and then come to the main thing. Okay, so my working one, as I told you, working one is your group structure. Okay, always label the working number and put a small subheading so that we know that working one is a group structure. If you don't put a label for it, we don't know what is working one, working two, working three. Okay, put a small label for it. Group structure. Now, they didn't give you in terms of percentage, right? So how do you find it? It's very easy. They have purchased 1.6 of the 2 million shares. So this is how you get it. Divide by 2 million into 100. This is how you get the percentages. How much you have acquired versus how much of equity shares you have. Okay, so this is 80% you're getting. Okay, so you have purchased 80%. Now, you need to understand which period is post acquisition, which period is not. Okay, this is on 1st of July 2004. Okay, and you have been given the statement for 31st March 2005. So the year end is 31st. So if you take from March, okay, April, May, June, so 3 months was what? Okay, so the acquisition took place 3 months into the year. After 3 months, that means if you 1st of March means it will be the year beginning will be 1st of April. You need to understand this 2004. 1st of April 2004 to 31st March 2005, and you have purchased when? 1st of July. So April the whole month, May the whole month, and June the whole month. 3 month after 3 month you acquired. Okay, so 3 month pre-acquisition, 9 months is the post-acquisition. Okay, 3 months pre-acquisition, that means before the acquisition 3 months went. So you don't have to consolidate the first 3 months, but the next 9 months you have to consolidate everything. You have to apportion it to 9 months. Now coming to working number 2. Okay, goodwill impairment. But remember, even for goodwill impairment, you need small workings. Okay, you need what? What do you need for goodwill? Goodwill impairment you need. First, you need to calculate goodwill. Goodwill has not been calculated for you. Okay, but you have been given the recoverable amount. So what do you need to calculate goodwill impairment? You're not calculating goodwill impairment. You need net asset of the subsidiary. Okay, first you need goodwill that you have to calculate, and then you need net asset. net asset of the subsidiary. This is another working 3, working 4. You need working for this to separate working. Like inside this, there's a working. Okay, and then you compare this with the recoverable amount. This is how you find goodwill impairment. Recoverable amount has been given in the last point. How much? 14.15. Okay, million. So we'll drop down the 3 zeros, so it's 14,150. This is the recoverable amount. But let's go and find out the goodwill and net asset. Okay, goodwill has been calculated using fair value method. Okay, so now remember, to find goodwill we need net asset, so we'll shift it. This becomes, we'll put this as working number 3. Sorry, goodwill will become working 4. Wait, I will show you why I did that change. You need to be very this thing. Why? See, even to calculate goodwill we need net asset. Without net asset we cannot calculate goodwill. So goodwill is dependent on net asset, but net asset is not dependent on anything. So better first calculate net asset then goodwill. So we'll put net asset as working 3 and goodwill as working 4. Okay, so working 3 is what? Net asset of the subsidiary. That's what we are finding out. Okay, always prepare 2 column. It's easier to work it like this: acquisition date and reporting date. Follow this order in any question in an SBR. If you follow this method, you will never go wrong from the track. Okay, this is a good way to stay in track. Always start with equity capital. If you have any share premium and all, that also you can add, return earnings and all. Here equity capital is how much you have been given. Even though you are not being given the statement of financial position, but you are given equity is 2 million. This is okay. Tudor purchased this much of Mr. shares, so it's 2 million. Okay, we'll drop down the 3 zeros, so it's 2000. Here also it will be 2000. You can deal in millions or thousands, is up to you. Next is, there is no other comprehensive income or other comprehensive equity or share premium, so directly return earnings. Okay, how much return earning? They told at the date of acquisition return earning was 6,150. Okay, at the acquisition date 6,150. But what about the reporting date? What about the reporting date? See here. Here you have to look at for the Windsor. Don't look at Tudor. Okay, you have been given here. This is the return earning. With this you have to add the profit for the year. This is the brought forward balance, and with that you have to add the profit, 3,000. So 5,400 plus 3,000 will give you 8,400. That is your reporting date return earning. It's always like this. Next is fair value adjustment. Any fair value adjustment will be taken here. Fair value adjustment of plant and equipment. Okay, or PPE. PPE. What was it? See, it was at 2 million, but fair value was 5.2. So the difference. Okay, only the incremental amount will go. So 5.2 million minus 2 million, which will be 3.2 million, right? 3,200. Next, it will be 3,200 here as well. Same. Now, depreciation. Because you have property, plant and equipment, don't forget the depreciation on that fair value. So depreciation also will be deducted. Depreciation of fair value. Okay. For this, you need a separate working. Right? we'll put as working 5. Okay, or if you want, you can I will directly show you the depreciation part. Okay, if you see, fair value is 3.2. Okay, now it has been for 4 years, so this fair value, okay, will not put working, will directly put it here. But it's always better to put it in a working, small working, if so many workings are there, rather than putting it there itself. But I will put it here for you. This useful life was 4 years. Into how many months? Only for 9 months you have to take, don't forget. You have to consolidate for 9 months. So when you do this, it will be 600,000. Okay, it will be 600,000. So at acquisition date, no depreciation. It's never. Always at the reporting date, you will have depreciation, which will be minusing it, 600. Okay, so now add up all, and here you will be getting 11,350. Here you will be getting 13,000. Okay, we'll keep it. We'll go to working for and find goodwill. Now you need consideration. This is the method for goodwill. Now you need fair value of NCI at acquisition. Then you need minus fair value of net asset. Now do you understand why you need that working 3 net asset? Because you need it here. So consideration, you have bought it for how much? 10 million to 80,000. Okay, 10 to 80. Now fair value of NCI. You've been given the fair value of NCI here, 2,520. 2,520. Okay, now 12,800. If you add up, then 11,350. You have to take this at acquisition. You have to take the fair value of net asset at acquisition. Okay, 1,450. Okay, 1,450. This is the goodwill. So what's next? After this, working 5. Anything to do with profit. Provision of unrealized profit, PURP. If you are selling it between subsidiary, parent to subsidiary, you'll be having this. Okay, now you need to understand this. This is given in point 2. Okay, here Vista sold. Okay, during post acquisition period, the parent sold goes to Vista for 12 million. This goods had originally cost 9 million. During the remaining months of the year, they have sold Vista sold 10 million of this goes to the third party. So Tudor sold goes to Vista for 12. Vista then sold this for 10 million. So how much is there? How much is there in the inventory? Vista is receiving 12 from Tudor. Then out of that 12 is selling 10 to the outside party. So he's only remaining with the 2 million. You understanding? Understand the whole picture. So 12 million minus 10 million. You are left with 2 million. Okay, this is an intra-group sale, which is in inventory. Now we'll have to find the profit. The profit that remains in the inventory. This is an unrealized profit. Okay, what is the profit part? We have to find out. What is the profit? See, they have sold goes to Vista for 12. Okay, so this 12 worth, there's originally the cost was 9. Understanding? The goods that Vista has received for 12 originally cost was 9. So now we don't care about the third party and all. Okay, when you are finding the profit, it is intergroup profit only we are worried about. Okay, So now from 12 the cost is 9, which is 3 million. Okay, and this you have to take multiply by how many months? For how many months? You have to check the year. It's very important. Let's see the year. In the post acquisition period, okay, now you have to remove it. Okay, this is, sorry, you don't have to take it for the number of months because it has not been given, but you have to take the profit. So this is how you find out. Okay, the profit. The profit is here. This is an intergroup sale, right? 2 out of the 12 that you have received. So 2 over 12 into this 3. This is how you do that. This is the profit that remains in inventory if you want to find out. Okay. Two over 12. Now it will be 500,000. Okay. Next. What's next? Profit that goes to NCI. Working 6. Profit attributable to NCI. This is very important section. Okay. First we have to take the profit of the subsidiary. That means the Winster. You only have to take for the 9 months. Okay. What is the profit? It is this 3,000. Okay. This profit for the year 3,000 you have to take. Only 9 months. Which is 2,250. Next, we have any excess depreciation and all. It's an expense, you have to deduct it from the profit. Was 600,000. We already calculated it before. Then we have goodwill impairment. This is also an expense which will be deducted. This was in working 2. How much we got? 300,000. In case you forgot, you can go back and check my video, which will give you 1,350. Okay, you have to take the NCI percentage, remember, of this profit. You deduct your expenses, which is depreciation and goodwill impairment, from the profit from Winster and get the profit, and then apply the NCI percentage. You bought it for 80, so NCI will be 20%. So 20% on 1,350 will be 270. Okay, now you're done with everything. Go back and complete the table. Okay, so let's do that from here itself. You have been given here. I will make the third column. Okay, so 60,000 plus, you have, when you're taking 24,000, you're only taking 9 months of this. Okay, I will write it on the other side. Only take 9 months of 24,000. Okay, I think this is more confusing. Okay, we'll take 9 months of 24,000. Okay, and you need to deduct any unrealized profit here. You see, you have made an intra-group sale of 12 million. This 12 million has to be deducted, intra-group sale. So you deduct 12,000, which will give you a total. I'll write the total here. Okay, I'll separate this, sorry. 66,000. Revenue will be 66,000 after consolidating. This is consolidated figure. I don't have space here, so that's why I'm writing there. Cost of sales, 42,000. With that, you take 9 months of 20,000. Okay. And again, you deduct your 12,000. Now you have to add your depreciation because they told depreciation comes under cost of sales. In some notes they have given. So plus 600 and also plus 500. What is that 500? Unrealized profit. You have to add it with cost of sales because it will increase your cost of sales further. Okay, then you have to, when you are deducting it, it will drive down your profit. But the total here will be 46,100. You have to do this on your own and check that you are getting this figure that I'm quoting here on the right hand side. That is 66,000 and 46,100. Do it and you should be able to get the same figure. Okay, this is plus. Gross profit will be 19,900. You don't add the gross profit, the two gross profit. Okay, that's incorrect. 19,900. I might not be in the same line, maybe. Am I? Yes. 19,900. Then comes your distribution cost. 2,500 you add 50, but 9 months of that 50. Which will be 2,538. You deduct. Then comes admin expenses. Admin expenses 3,500 plus 150, but 9 months of it. And plus 300. 300 is your goodwill impairment. Goodwill impairment comes under admin expenses. They have given under some note. So 3,912. You deduct. Then profit from operation. You don't add. Okay. You get an individual figure. 13,450. After that, investment income. Old is 75. Then finance cost. You take 9 months of 200. Which will be 150. You deduct. And you get profit before tax. You don't add. You get an individual figure. 13,375. Then tax 3,000 plus 9 months of 600, which will be 3,450. You deduct. Then you get profit after tax, which is 9,925. Okay. After this, there is another step. What is it? You have to attribute the profit. Okay. So profit attributable to. One is owner of the parent. Okay, I'll write P. P is the balancing figure. Then I'll write NCI, non-controlling interest. Already you have done it. Non-NCI. Okay, NCI figure will be, this is why you have done the NCI figure. This one, 270 will go. So this 270 will be here. How are you going to get? See, this profit has to be, I'll highlight it for you, 9925 only. Okay, here also it will be 9925. So just go back, 9925 deduct 270 to find the balancing figure. That is to get for the parent. Okay, which is 9655. So it's here 9655. Okay, that's how you get it. So that's it. Now we'll go to the step accusation. Coming to the step accusation. Step accusation means when you are buying the shares in slug or in blocks rather than buying it all at once. You are buying the shares at different times. Okay, so you're acquiring the control in stages. Let's say you have first bought 50% or 40%, then you bought another 30%. So that 40 and 30 becomes 70, giving you a control. You understanding? Okay. So now, remember, you only have to consolidate when you have acquired the control. That means when you have bought more than 50%. Otherwise, you don't have. Okay. So in this case, when it's a step accusation, how do you deal with it? Any pre-existing equity interest in an entity is accounted to according for. When you go for a step accusation the next time, so whatever was there the first time that you have acquired, now you need to value it. Okay, you have to value it in fair value. Okay, so this is how you account for it. If it's less than 20%, okay, before you got control, whatever you had first time you bought, let's say 20%, or let's say 19% shares you have bought the first time, not the second time I'm talking about. So then you have to, the second time when you bought more shares and got the control, you have to now value the first one according to IFRS 9 if it is less than 20%. If it's more than 20 and less than 50, IS 28. And if it's a joint arrangement, they will tell you then IFRS 11. Okay, IFRS 11 is, by the way, the next standard also after this lecture. After IFRS 10 is IFRS 11. It's a small standard which we are going to go through. Okay, but IFRS 9 and IS 28 I've already covered. Please go back and check. Okay, now, and the date when the equity interest is increased and the control is achieved. Remember, earlier there was no control that you have achieved, but when you achieve that control, this is how you have to do. You have to remeasure what was previously there, remeasure the previously held equity interest to fair value, then recognize any gain and loss. Okay, and if it's a financial instrument and you have designated it fair value through other comprehensive income, then any gain and loss goes through there, other comprehensive income. This is only for IFRS 9. Okay, if you have designated so. Otherwise, everything goes through profit and loss, all gain and losses. Third, you need to calculate goodwill. The day you have acquired the control, goodwill needs to be calculated, and also NCI. Okay. Now, this is the pro forma. This is how you calculate goodwill. First, this is for step accusation. We know normally how we calculate goodwill, but if it's a step accusation, this is how goodwill is calculated. Little changes there. You add with your consideration, okay? Fair value of previously held interest plus fair value of consideration for additional interest. That means when you have got the control. Add both. And NCI also you add, and deduct your fair value of net assets at acquisition. We are going to do a question. Okay. Then you get your goodwill. Next, any gain and losses. Remember, any gain and loss that goes through other comprehensive income, okay, does not go through P&L. You cannot reclassify to P&L. Why? This is only for those equity that has been classified as other comprehensive income. Okay, this is according to IFRS 9. So even if you're remeasuring it, it will not go through profit and loss. You need to understand this. Next, purchasing further shares in a subsidiary after control has been acquired. Let's say from 60 to 70. Okay. Even at 60, you have acquired the control. So even at 60, you are a subsidiary. Even if you're at 75, you are a subsidiary. You are still a subsidiary. So in that condition, you do not recalculate the goodwill. Goodwill is only calculated once. When you first bought the 60%, goodwill was calculated that time. When you bought another 15%, goodwill is not recalculated again. You keep the original goodwill. Understand? Why? Because this is not considered as a sale or a accusation. It is regarded as a transaction between equity holders. That means your NCI is reducing and your shares, majority shares are increasing, minority is decreasing. It is just the shareholders are changing their hands. That's it. This is not actual transaction between a buyer and a seller. Okay, that's why goodwill is not recalculated. This is what you need to understand. Even for the disposal is the same thing. It's just the opposite. It's just transaction between equity holders. Now, next is a disposal of subsidiary. But before we come to a disposal of subsidiary, same way how we have done for the mid-year accusation, we are going to do step accusation, a question. So let's do that. Illustration 2. Here you have been given three companies, Ayer, Fleor and Bayer. Okay. Let's see which one is a subsidiary, which one is an associate or a financial instrument. Okay, I has owned 90% of Fleur, so this is a subsidiary. Okay, also has a 10% investment in Biner. Okay, so 10% is a IFRS 9 financial instrument because it's less than 20%. Okay, which is measured at fair value through profit and loss. Okay, and on this date it was held at 24,000 in accordance with IFRS 9, and on 30th of June they have acquired a further 50% at a cost of 160,000. You see, so 10 plus 50 becomes 60%, and then it becomes a subsidiary. But already it becomes a subsidiary for the few months. How many months? Year end is 31st. You have acquired at 30th June. So only for 6 months. July, August, September, October, November, December. Only for 6 months is a subsidiary. So this is for 6 months. You have to take. Clear? 100% you can consolidate. But for Briner, you have to take only 6 months, last 6 months. First 6 months, it was you have to account it according to IFRS 9. Okay. Here, you have been given NCI. It is calculated at fair value. Net asset has been 200,000, NCI 100,000, 10% investment was at originally 26,000. Prepare consolidated statement of profit and loss. This is similar to the previous one. Okay. I think little easier also. So here itself only I will show you. Wherever working is required, we'll go to the workings. Less working is required in this question. 500 plus 300 plus 6 months of 200 if you're taking the revenue, which will give you 900. This is consolidated. Okay, now come to the cost of sales. 300 plus 70 plus 6 months of 120, which will give you 430. You deduct and you get the gross profit of 470. Then operating cost 60 plus 80 plus 6 months of 60, 170. You deduct, and profit from operation you get is 300. But you have to wait here. Why? When you have an equity investment, okay, see here earlier you had an equity interest, right, or equity investment, let's say, according to IFRS 9. Now you have to de-recognize it. Why? Because now it becomes a subsidiary. Once it becomes a subsidiary, you have to de-recognize it. When you're de-recognizing it, it's like you're selling it. You're selling your financial instrument and you're becoming a subsidiary. So when you're selling your financial instrument, you have to recognize a profit. That profit needs to be added here after profit from operation. Okay, that is profit on derecognition of equity investment. Okay, I'll write it here. This profit you have to calculate in working one. Okay, let's put that as working one. Then we'll keep it separate. We'll keep a space. Then we have income tax 28, 30 and 6 months of this. Okay, this also add, which becomes 60. Okay, then we are left with profit for the period 240. Okay, profit we cannot write because we don't know this one yet. Okay, and profit attributable to, we'll write that. Profit attributable to the equity holders of the parent, that means the parent, P and NCI. NCI will do a working too. Parent is the balancing figure. Okay, So that shows we have two workings. Okay. Now, we need to calculate what? Profit. But before profit, okay, we have to find the investment. Just a minute. Okay. So here, this is step accusation, and you need to remember that previous investment in shares, the IFRS 9 must be revalued to fair value. Okay, and any gain on revaluation goes to statement of profit and loss. So here, you see, originally it was for 26,000. Okay, and you are selling it for how much? It was held on 31st December at 24,000. So the difference will be the, you have to debit. Okay, that's a revaluation gain. So you need to debit your investment. Okay, 26,000 minus 24,000, which is 2,000, and you need to credit this in profit and loss. It's a gain. Okay, now we'll put this 2,000. Okay, this 2,000 is the profit on derecognition of this one. Okay, originally bought for 26 and then it was 424 on 31st. Okay, so now 2, so it becomes 242. Now let's do for NCI. Okay, remember, yeah, so what else? Working 2 is for NCI. Okay, profit attributable to the NCI. Now profit of this one. What is, which one? See, only this one will talk about NCI. Okay, not the second one. 120. This is 120. Now take 10% of it, because we have acquired for 90%, so NCI is 10%, which is 12. Okay, now profit of Bryony in the consolidated profit and loss. You have to take post acquisition profit. Oh no, profit of Bryony, sorry. This one, after this becomes a subsidiary, you have to take their profit, but only for 6 months. Okay, what is their profit? 16. So of this 16, you take 6 months, which is 8, and apply 40%, because when it becomes 10 and 50, it becomes 60. So NCA is 40%. So apply 40% to 8, which is 3.2. Because NCA percentage is separate, you have to do like this. Okay, so add 12 and 3.2, which becomes 15.2. This is the profit that goes to NCI, 15.2. Okay, so here we wrote that profit attributable to this one and this one, right? So this will be 15.2. Remember, the profit is 242. Okay, 242. So 242 minus 15.2, which is 226.8. This is how you always get. The parents one is always a balancing figure. Only the NCI you have to work. Okay, that's it. So now we'll be moving on to the disposal. Before disposal, we have to do one more question, which is test your understanding 1, which is major and term. So here we are supposed to discuss how to account for the purchase of additional 20% holding in term in the consolidated financial statement. Okay. When the word comes discuss, remember you have to write also. Okay. You have to write and you have to do some calculation. It is not entirely calculation. Okay. So here, Major is a public limited company and it has numerous subsidiaries. Okay. Now, Major has acquired 40% of Tom. Now we all know when it's 40%, okay, it is not a subsidiary. It is an associate at that time. Okay, so very well you know that when it's an associate, you have to use equity accounting. Okay. Now, so they have acquired 40% of Tom's 100,000 $1 ordinary shares. Okay, for 90,000 in cash. Now, the retained earning was 76,000. He has also acquired further 20%. So we all know that when it's a further 20%, 40 plus 20 gives you 60%. So with 60%, you are having the control and you become a subsidiary. Now you have to consolidate. Okay. For how much? 70,000 in cash. Okay. On this date, the fair value of the previous 40% was 105,000. Their retained earning balance was 100,000. NCI will be on a proportion of net assets. So you will not be given the fair value of NCI. Okay. You have to calculate goodwill and all those things are needed. Why? Because it goes in your consolidated financial statements. Whatever the things that goes there, you need it. NCI, goodwill, net asset, retained earnings, all these things you need. So how do you start this question? How do you start answering this? We all know what to do, right? We'll calculate goodwill and we'll do, but exactly how to start? You have to talk about 40 to 60%. You have to say when it was at 40%, it was an influence, significant influence. That means no control. Significant influence, and also it's an associate. So you have to use equity method, equity accounting or equity method. You have to mention by this. Okay. Always when you're answering, please answer in a chronological order. The information given to you in that order. Don't immediately start talking about subsidiary and 60%. Start with the 40% first and then we'll talk about the 60%. So you have to start with this. Okay. Initially, they didn't have control, but they achieved this control in stages. You have to talk about that step accusation. This is what it is. They have got it in stages, the control. This you have to mention. Okay. So IFRS 3 also says that any previous investment has to be revalued to fair value and everything goes to P&L. Okay. You have to talk about this. Okay. You have to talk about the previous investment. Okay, I'll write it down. I'll write it down in bullet point for you. Okay. So that you can answer, but you have to write it in proper sentence. Okay. In paragraph. Previous investment. You have to talk about previous investment when it is at stages. Okay. Previous investment revalued to fair value. It must be revalued to fair value. This is always. Okay, whatever the investment is, it could be a financial instrument, it could be an associate, it could be a joint venture, anything, whatever it is, it has to be revalued to fair value. Okay, and where does gain and loss goes? Gain, loss goes to P&L. Next paragraph. What is it? So secondary plus associate, equity method, and previous investment. We have talked about those 4 things. What else? So initially, you have to talk about initial recognition. Initially, it will be recognized at cost. It's an associate. Initially recognized at cost. What amount? At 90,000. This 90,000 because you have acquired it 90,000 in cash. So it will be at 90,000 that you will recognize it. Initially recognized at 90,000. You have to write this amount. Okay. Now, remember this is an associate. You also have to recognize the associate's profit. major's share on associates profit. Okay, and also any comprehensive income. So now, what was the, you have bought it for 60, so NCI will be 40%. Associate was for 40%. 40% of the profit you have to add with the 90,000. How much is the profit? The difference between the two retained earnings. You see, retained earning was 100,000. 31st December 2006. This one. Okay, I will highlight it for you. It was 100,000. Then it was 76,000 in 2004. So the difference between the retained earnings is your profit. It increased from 76 to 100,000. That is the post-acquisition profit. So 100 minus on that you apply 40% and you add it with 90,000. Okay, plus. Okay, sorry, 90,000 plus. You add your 90,000. That is the cost. With this cost, you add this profit part. How much it will be? The answer will be 99,600. This is the amount your associate will be. Now, next paragraph will be when on the date when you have achieved the control. When control is achieved. This is the next paragraph. What do you write? Previous investment will be revalued to its fair value. What is it? Previous investment revalued to fair value. How much? I think they have given the amount here. They have already given the amount. I will highlight it for you. 105,000. They have already given the fair value. 105,000. So this will be that. 105,000. It will be at this amount. And remember, this will be included in your goodwill calculation. You have to write this because you are discussing, right? Included in goodwill calculation. If you remember the formula of goodwill calculation in step acquisition, you will know this. The fair value of the previous investment is also included in the goodwill calculation. Now, what about the gain? There will be a gain. See, associate, that means previously it was associate. So previous investment was this 99,600. Now it is revalued to 105,000. So there will be a gain. Okay, how much? Gain 105,000 minus 99,600. How much is the gain? 5,400. Where will this gain go? Profit and loss. Profit and loss. P&L. Okay. Remember, because you have achieved the control, also you have to recognize net asset at fair value. NA at FV. The subsidiaries net assets you have to recognize at fair value, and this also will go in your consolidated financial statements. Remember that. And also you must recognize goodwill on this date. Right? All this you have to write while you're discussing. Okay. So now we'll calculate the goodwill finally. Okay, so we'll start with fair value of previously held interest, or we'll say fair value of associate, because before it was an associate, which is 105,000. Then we have fair value of consideration for additional interest. Okay, not when you're buying it for the first time, but when you got the control. Addition, fair value of consideration, not this 90,000. Okay, this 90,000 is for associate, but this 70,000 you have to take when you have achieved the control. 70,000. Next we have to add NCI. So NCI when you're taking, it's a proportionate method. That means you have acquired 60%, NCI will be 40%. 40% of net asset. What is the net asset? What is the net asset? See, net asset is 100,000. This is the share capital. Okay, I will highlight it for you. Maybe I'll highlight in different color. 100,000. Okay, wait. This 100,000. Okay, share capital and the retained earnings. Retained earnings how much? This 100,000. So this 100, 200,000 is the net asset. So 40% of 200,000 is 80,000. Then you deduct, sorry. Without this, you deduct net asset. Just now we saw that, right? Share capital of 100 and return earning 100,000. So it's 200,000. So the answer is 55,000. This is a goodwill. You only need to discuss. So you have discussed and you show the goodwill. That's it. This much will give you the marks. Now we'll be moving on to the disposal. Disposal of a subsidiary. Remember whatever I've explained you in accusation, similar rule you apply in disposal, except that now it's an opposite. Okay, here you lose control. Okay, you might sell all the shares or you might sell partially some shares, but where it is causing you loss of control. There it was gain of control, here it's loss of control. Okay, possible situation. Maybe you have disposed all the shares in the subsidiary, or you have disposed partially, but the residual after the sale is so less that it's less than 50%. That means it's an associate. Or if it's less than 20%, it's a financial instrument. But whatever the case is, you're losing control. Third, okay, disposal of part of the shareholding, leaving a residual holding after the sale, which is regarded as a trade investment. Yes, trade investment is financial instrument. Just I've said that right now. Yeah. Now, so accounting treatment of all of the situation is very similar. Whether it's one, whether it's two, whether it's three, whether you're selling partially and having an associate, partially and having financial instrument, or selling entirely, you are losing control, and accounting treatment is same in all these three conditions. Okay. In the individual financial statements, this is how you do it. You have to calculate a profit. Obviously, when you're disposing, it's a profit, right? So profit on disposal needs to be calculated. And in your individual financial statement, this is how you do that. Sale profit minus your carrying amount of the shares sold. Profit and loss. Okay. And this profit and loss is reported as an exceptional item, and it is disclosed separately on the face of the parent statement of profit and loss. Okay. Now, in the consolidated financial statement, see, whenever you are going through group accounting, know two things. One, in the individual financial statements, how it will be treated. Number two, how in the consolidated financial statements it will be treated. You have to know this, because sometimes they can ask you individual financial statement also, not always consolidated. Consolidated, definitely you have to know. Individual, sometimes they ask. So don't take the risk of not knowing individual financial statements. Know it. Okay. Now, control is lost. So here the treatment will be, you consolidate all income and expenses up to the date when control was there. Next, de-recognize all your assets, liabilities, goodwill also, because you have calculated goodwill when you gain the control. Now that you have lost the control, de-recognize goodwill. Goodwill is also an asset, and also NCI, de-recognize. Okay, and calculate profit and loss on disposal instead. Okay. Next, if, okay, yeah, there is more. Okay. Next, then you have to recognize any remaining investment in the form of subsidiary at fair value. Okay, and subsequently account for this under the relevant accounting standard. It could be anything. It could be a financial instrument. Then according to IFRS 9, if it's an associate, then see, it depends. If it's a subsidiary becoming an associate, okay, the rule will be you have to apply the IS 28 if it's an associate. Okay, they will be, usually they will give you the fair value. The easiest thing is they do not twist this thing a lot. They usually give you the fair value of the remaining investment. Okay, so that's a good thing. Next, let's say a holding of 20 to 50%. Okay, that means the remaining investment is an associate. So you use equity method. And if it's less than 20, IFRS 9. Now, this is the following template, okay, for profit and loss. This was a proceed. This is for in the consolidated, okay. Individually, it's just sale proceed minus amount of the shares sold. Here, disposal proceed, add the fair value of retained interest, and you have to deduct this net asset because it was a subsidiary before. So all the net asset less, goodwill less, NCI deduct. I mean net asset goodwill minus NCI. That whole amount you deduct. Okay. So do this in the inner column and disposal proceed and fair value of retained interest in the outer column. Okay. Do exactly the way it's given. Then so that it does not lead you to confusion. Okay. Add profit and loss to the group. This is how you do that. Now let's do some questions before we move on to the subsidiary specially held for resale. That is dealt according to another standard. Illustration 3. This question is based on the first situation where you are selling the entire shares, 100% shares you are selling. Okay, so he has held a 70% investment, okay, for 2 years. Goodwill is calculated using full goodwill method and no impairment is there, and you have been given the information. A, individual financial statements. B, consolidated financial statements. How do you account for profit or loss? Cost of investment has been given, net asset 1.9, NCI 800, sale proceed and net asset at disposal has been given. Okay, so now individual financial statements is quite easy. You just find the sale proceed. Okay, and cost of shares sold. So sale proceed is how much? 3,000. This one. And cost of the share sold, it's 2,000. Cost of investment. So the profit is 1,000. Profit on disposal. Coming to B. B is little tricky. Okay, you start with sale proceed. SP 3,000 only. We'll keep it in the outer column. Then in the inside, you have to less all that you have to deduct. What is it? Because you have sold entirely, you will not have anything to fair value. Okay, remaining investment at fair value, nothing like that, because entirely you have sold. So net asset, goodwill, and NCI. Net asset has been given to you 2,400. Net asset at disposal. We'll put this in the inside column. Goodwill you have to calculate. NCI you have to calculate. Okay. Carrying amount of the NCI at disposal. NCI was there when 70% investment was there, but now you have to de-recognize that. But first you have to calculate goodwill. Okay. Working 1 and working 2. Working 1 for goodwill. You start with consideration. What is it? 2,000, because this was the cost of investment. Then NCI. How much was the NCI? 800. This is at accusation. And minus net asset. Already they have given you 1,900. This is at accusation. Okay, net asset at accusation we are taking. This one. 1,900. So then you are left with 900. Goodwill. Okay, this 900 only you have to take here. Then you deduct net asset. Sorry, NCI. NCI you have to work out. Okay, NCI at accusation was 800. Then NCI percentage on post accusation profit. %70 was there, right? So NCI will be 30%. Post accusation profit. How much? You have to check the net asset. The moment in the net asset is the post accusation profit. So at accusation, net asset was 1,900. At disposal, net asset was 2,400. The difference. which is 150, which is 950. This 950 only will be at disposal here. Okay, so which will be 2350. The inside column calculation will be 2350. Deducted from 3000 will give you 650. This is the profit. So profit on consolidation and individual statements are different. Okay, understand this. You will not get the same profit. Now we'll be moving on to illustration 4. Illustration 4. This is the second situation where you are partially selling shares, not the entirely, and it is becoming an associate from subsidiary. Okay, so you bought at 70%, you are disposing 25. So 70 minus 25, you are left with 45%. Less than 50, it's an associate. Okay, so you dispose 25 at this amount, 125,000. Full goodwill method, goodwill was impaired and written off in full prior to the year of disposal. That means before the disposal, no goodwill was there. Net asset at disposal is 340,000. Fair value 45% is this one, they have already given you. The fair value of the retained interest, 245,000. And carrying amount of NCI was 80,000. Discuss the accounting treatment of the above in the consolidated financial statement. The moment it says discuss, you need to write. So the writing part I will not do. That you can do by now. Okay, because you have seen the previous questions how I've discussed. You have to say about the loss in control. Okay, this word has to be there. It's a keyword, loss in control. So it's becoming an associate from subsidiary. You can give the percentages also. Okay, so also you have to talk about profit and loss, that you have to calculate a profit and loss on disposal. This terms has to be there in your answer. Okay, now you will calculate. You start with sale proceed. It was for 125,000. Then fair value of retained. Here you will have a fair value of retained interest. Why? Because you didn't sell 100%. But in the previous one, you have sold entirely. That's why there's no fair value of retained interest. RI retained interest, 245,000. Which is giving you 370,000. Then we have net asset. That you have to, and goodwill, there's no goodwill. NCI. Okay. Net asset was 340,000. They've already given you. And NCI also 80,000. It's a deduction. So 340 minus 80 to 60,000. You have to deduct from 370. Then it becomes 110,000. This is the profit. Okay. So then you have to say that the remaining interest, you have to talk about associate. The remaining interest is an associate. Okay. You have to mention the word remaining investment is an associate. That means the 45% holding is an associate. And use equity method. All those things you have to write in your answer. Okay. You have to say that this investment will give a significant influence as well as an associate. Okay. And you have to say that from this date, that means from the date of the disposal, equity method will be used. Okay. Now we'll go to test your understanding 2, the next question. Test your understanding 2, pet store. Here, look at the verb. Okay, here they say calculate, here it says calculate. So when they say calculate, you don't have to discuss, just calculation. But in the previous one, they said discuss. Whenever it's discuss, you have to show a little calculation and write. Whenever it's calculate, entirely calculation. Okay, calculate profit and loss on parent entity, calculate profit and loss on group. Okay, here also you are selling entirely. Let's see. 80% was purchased for 100,000, sold all of its shares for 250. Net asset at acquisition was 69, at disposal it was 80, 88. 50% of goodwill has been written off. Okay, fair value of NCI is 15,000 and full goodwill method. Even if they don't say full goodwill method, it is understood. Why? Because they have given it the fair value of NCI. Whenever fair value of NCI is given, is full goodwill method is understood. So now you should be quite competent on this area. We have done 2-3 questions before this. So quickly you'll be able to tell me. A. To the parent means individual. Okay. Sale. Proceed. How much? 250. 250,000. I'm selling it for 250. This one. How much? 100,000 of this thing. So you are left with 150,000 profit. This is the profit. This is very easy. Okay, let's come to B. B is consolidated. Here also we have sale proceed. Outer column 250,000. But we have fair value of retained. We are selling entirely, so we don't have any fair value. We are deducting what? Net asset, goodwill, NCI. Net asset at disposal is how much? 88,000. Goodwill, they have told 50% is there, but you have to do a working, and even for NCI working too is required. So we'll do working 1. First is consideration. You bought it for 100,000. Then NCI. They have given you the fair value 15,000. Then net asset at acquisition, not at disposal date. 69,000. It is 46,000. But they have told 50% written off. So 50% of 46,000 is 23,000. You can say this is an impairment, so you are left with 23,000. Okay. Next, NCI at disposal date. You start with NCI at acquisition, 15,000. Post acquisition profit, NCI percentage. On post acquisition profit, that is this thing, difference between the net asset on the disposal date and the acquisition date. 20% is NCI because you have bought 80%. So 88 minus 69,000, which will give you 3,800. And you have to deduct NCI. Remember, when you're having an impairment, you have to take the NCI percentage of that also. It's an expense, which will reduce your profit. NCI percentage of impairment. This is a full goodwill method. So you have to take the NCI percentage of impairment, which is 20% of 23,000. Just in working 1, we have done it here, right? So 4,600, which will give you 14,200. This one. So this will go up and right here. $14,200. Here outer column it will be 96,800. That you have to deduct from 250,000. 153,200. This is your profit on your consolidated statement. Now we'll be doing test your understanding 3. Test your understanding 3. Okay, here you have a 60% investment and full goodwill method is used. half of the goodwill has been impaired. You have been given the cost, fair value of net asset at acquisition, fair value of net asset at disposal, 40% investment, what is the fair value, 25% investment, what is the fair value. Okay, so you have in part A, okay, assuming a full disposal, what is the and the proceed of 10 million, you have to calculate profit and loss for individual and consolidate it. B, assuming a disposal of 35% with the sale proceed of 5 million. Okay, here in the consolidated, what is the profit and loss? And here you need to explain. All these are calculation except the last one. Explain how the residual shareholding will be accounted for. Okay, so let's start with A. Okay, where it is a full disposal. It's a full disposal. Full disposal is actually a little easier compared to partial disposal. Okay, so in the individual financial statement, the first part is just the sale proceed and cost of sale shares. Sale proceed, cost of share. So it was 10 million. Right? We'll drop down the 3 zeros. So 10,000. I know my handwriting is little bad, but okay. And cost of investment is 6 million. Okay, which is 4,000 or 4 million. So this is the profit in the individual financial statements when it's a full disposal. Coming to consolidated, here also sale proceed 10,000. Fair value of retained interest, there will be no fair value of retained interest because this is full disposal. Okay, so you are deducting net asset, goodwill, NCI. Okay, net asset at disposal is 3,000. Goodwill and NCI you have to calculate. 3,000 here, working 1, working 2. So we'll go and do working 1. Okay, goodwill. You start with consideration. Investment was for 6 million or 6,000. Then NCI at acquisition. They've already given you a net asset at acquisition. So NCI they have given you what is the NCI? Fair value of 40% investment at an acquisition date. So from 40 to 20, earlier it was 40%. Okay. Sorry, for 60% investment and fair value of 40% investment at acquisition. This is they're talking, this is NCI only. In other words, NCI is named as like this 40% investment. Because if you're having a 60% means NCI is 40%. So it's 1 million. And then you deduct your net asset at acquisition, which is 2 million. 2 million. Okay, so you're left with 5 million, but 50% is impaired. So 50% of 5,000 is 2,500, which is 2,500. This is the goodwill. This is the impairment. Okay, now working 2. NCI. So NCI at acquisition is 1 million. Then we have post acquisition share. NCI percentage on post acquisition share. That means that is the retained earnings basically. So 40% will be NCI. Changes in the net asset, I'm sorry. So which is here. Net asset at disposal 3,000, net asset at acquisition 2,000. So 3,000 and 2,000. Always the moment in your net asset is the post acquisition profit. Okay. which will be 400. Then remember impairment is there. So you have to take the NCA percentage of impairment also. %40 on impairment. What is the impairment? 2,500 from our working one we got, which is 1,000. This you deduct. Then you are left with 400. Okay. So go back and fill the table. Goodwill was 2,500 and 400 was NCI, which is 5,100. So you're left with 4,900 on profit. This is profit on disposal in the consolidated. Now the second situation where you are partially selling. So this is done, this is done. We are disposing 35% from 60, 35%. Okay. So B, okay. When it's B, there are also two parts to it. First one, in the consolidated financial statement. Okay. So we'll do that. Okay, you start with sale proceed. And the total is 5 million. Okay, for B, sale proceed. Sale 5,000. This time you will be having a fair value of retained interest. They have already given you 3,500. This one. Because from 60 when you're selling to 35, we are left with 25. So 2,500, 3,500, 8,500. Then we have net asset at disposal, goodwill, NCI. Here again we have working 1 and working 2. Net asset at disposal is 3,000. This is the same. Okay. Goodwill will also be same here. What we have got in the previous. Even here NCI will be same. So you don't have to recalculate each time. Once calculated, use the same figure. Okay. Which is 5,100. The only change that comes here is in the sale proceed, that is from 10 million it went down to 5 million, and now you'll be having a fair value of return earnings, return interest. Before you didn't have that part. The down part will be same, 5,100. So 3,400 profit. Okay, and in the second part of B, you are supposed to explain the remaining investment accounting treatment. Okay, it becomes an associate. So remaining is that it's an associate. You're losing control and having a significant influence. So equity method. These are the keywords. It has to be there in your answer. Okay. So residual holding will be accounted using equity method. Okay. You have to talk in the two places. One is statement of profit and loss. The other one is statement of financial position, SFP. So here in this one, what will it show? The group share of the current year profit earned by the associate. Group's share of current year profit associates current year profit. From the date they have got significant influence. Okay, this you have to write. So group's share of the associates current year profit. And in the statement of financial position, what are you writing? Carrying value of the investment in associate. Carrying value of the investment in associate. This is the one. Okay. So this will be the, what will it be? You have to show that, you have to write it. This will be, that means what will be the carrying amount? This will be the fair value of the retained shareholding at the disposal date plus. Okay, that basically you're writing the formula in words here. Okay, this will be the FV, fair value of retained shareholding fair value of retained shareholding at the disposal date plus, okay, plus what? Recall the formula. Group's share of the increase in reserves from this date. That means the profit. Group's share of increase in reserves from this date or in profit from this date. Okay, done. Now, how do you present subsidiary, the disposed subsidiary in the consolidated financial statement? There are two methods. Okay, number one, time apportionment line by line. Okay, so in the consolidated statement of profit and loss, the income and expense of the subsidiary are consolidated up to the date of disposal. Okay, that means line by line you apportion the sale, the expenses, line by line you do that. Then the profit or loss on disposal of the subsidiary, this is presented as an exceptional item. Okay, now second way is discontinued operation. Okay, how? This you can only write it as discontinued operation if it qualifies under IFRS 5. Okay, that means a subsidiary held for resale. So if the subsidiary qualifies as a discontinued operation according to which standard? IFRS 5. We have already finished IFRS 5. Please go back and check if you want to recall some of the rules of IFRS 5. Okay, that is non-current assets held for resale and discontinued operation. Okay, so if it qualifies, then the results are aggregated into a single line on the face of the consolidated statement of profit and loss. That means all the results of subsidiary will be shown as a discontinued operation. Okay, and this is presented immediately after the profit for the period from continuing operation. How do they write it? Profit from discontinued operations. Only as a single line, one item. But they will add all the profit of the subsidiary. And then they will show that one figure after the continuing operation. Okay, so single line compromises two things. One, profit and loss of the subsidiary up to the disposal date. Next, profit and loss on the disposal of the subsidiary. Okay, now let's do test understanding 4, a question on this before we move on to issue where even if you're buying or you're selling, you're not losing or gaining control. That is called control to control scenarios. Test understanding 4, Kathmandu. Okay, we all know that it's a capital of Nepal. Okay, so you have been given the statement of profit and loss for the Kathmandu group and Nepal. Okay, you have been given the extracts of statement of changes in equity. SOCIE stands for that. Okay, there were no other items of other comprehensive income. Thank God there is not. Okay, additional information. The accounts of Kathmandu do not include results of Nepal on 1st of Jan Kathmandu acquired 70% for 100,000. Fair value of net asset was 110. Equity capital was 50. NCI is at fair value 40,000. Nepal paid dividend in cash. Goodwill has not been impaired. So there are three requirements, A, B, and C. A, when you are selling, okay, for 200,000. And this disposal is not yet recognized in any way in Kathmandu's group statement of profit and loss. How do you account for it if it's not under IFRS 5? Does not represent a discontinued operation. B, if it's a discontinued activity according to IFRS 5, how it differs. You have to explain and you have to illustrate how the presentation of this will differ from part A. Don't remember, you don't have to change part A. How it will differ from A, that's what you have to show. In A, it does not satisfy IFRS 5. B, it satisfies IFRS 5. C, you are selling half for 100,000. Okay, and the residual of 35%, the fair value is 100,000. That is an associate later on. Okay, so let's do that. Just a minute. Okay, so you have to prepare a consolidated statement of profit and loss for full disposal. Okay, so we can show it here itself in this. Okay, so 553, you'll be adding it with Nepal, but remember, only when you're disposing it. It is for 31st December 2009. When are you disposing it? On July. On July you're selling. That means exactly 6 months. So only the 6 months results you have to consolidate. Okay, so here when you're taking 553,000, you are adding, but only the 6 months of 450,000. All in fact is 6 months. That means half of 450. So when you're adding the two, it will be 778,000. Remember, this is the consolidated part. According to A, when you are disposing it entirely, full disposal. Okay, coming to operating cost. Operating cost was no change. You can just take as it is 6 months of this, which will be 650,000. And the gross profit, operating profit, you don't have to do anything. You don't have to add the two operating profits. Please do not make the mistake of adding 103 with 50,000. It's incorrect. Rather, it should be 778,000 minus 680,000. Sorry, 650,000. This is 128,000. This is your operating profit. Then your investment income. Okay, investment income, there'll be a change, because if you are disposing it, okay, or anything like that, it will be taken there as an investment income. Okay, investment income, there's a working, and then you have to add a profit on disposal. When you're disposing this subsidiary, there'll be a profit on disposal that you have to write. Working one is there. Okay, tax, just take 6 months of this. It will be 47,000. Profit for the year we still cannot attribute because we need that profit on disposal and investment income. Okay, and then you have to attribute it to the parent and the NCI, the profit for the period. Okay, when you are showing it for the two, that is attributable to parent and NCI. This is balancing figure always, And here there's a separate working to find the profit attributable to the NCI. Okay. Now, so we'll go to working 1 and we'll find the profit on disposal. Okay. This is for part A. So we are starting with the proceed. Okay. You're selling it for how much? They have given the amount. Exactly. Oh, they have given here. For 200,000. Here. In requirement they have given. Remember, sometimes in that big working, you need small workings there. Okay. So 200,000 is the proceed. Then net asset, because you are disposing it entirely, no fair value of retained interest. Okay. Net asset, goodwill, NCI. Net asset, you need working 2 here. Goodwill, working 3. NCI, working 4. So this means this profit attributable will be working 5. Okay. Now let us go to working number 2 and let us do net asset. I know it's a bit too much, but what to do, that's the nature of SBR. Okay. So net asset, you add your share capital, your return earnings. After that, any profit up to the disposal date. Profit up to disposal date. And dividend paid prior to disposal. Okay. So your share capital will be here. Okay. You need your this extracts. That's why this is given. And you have to find the Nepal. Okay. So here return earning is 80,000. Okay. Profit up to the disposal. When you are taking profit for the period, you have to take 6 months of this only. Half of 36,000, which is 18,000. And dividend paid, which is 10,000. You have to deduct. But what about the share capital? You have to get it from here. Nepal has an equity capital of 50,000. They have given you in the additional information. You should have the skill of picking information from various areas, additional information, the requirement, the table, everything. Okay. And this should be very quick. This is where most of the students waste time. Okay. Picking the correct number, 50,000, and they don't know which place. They keep struggling and looking for the number. So 6 months of 36 is 18,000. And deduct 10,000 dividend. And you are left with 138,000. Okay. We'll immediately go to working 3. Goodwill. So you start with consideration. 100,000 was the consideration. Then NCI. Then net asset. So NCI, they have already given you, I think, 40,000. Yes, 40,000. And net asset, they have already given 110,000 at the date of acquisition. It's there in the additional information, you will get it. So goodwill is 30,000, no impairment. And working 4, NCI. So this is NCI. Fair value of NCI is already given as 40,000. Post acquisition profit NCA percentage, that is 30%, because when it was 70, NCA will be 30%. Okay, already you have calculated your net asset at acquisition, that is 138,000. Sorry, 138,000 is at disposal. I'm sorry. Then at acquisition it was 110,000 net asset. 8,400. 48,400. And working 5. Profit attributable to NCI. Remember, profit of Nepal is just 36,000. So just apply 6 months on 36,000, which is 18,000. Okay, and take 30% and apply here, which is 5,400. So you have done all the workings. Now what we have to do is just go back and put the number. Okay, in the correct places. Wait. So we were stuck with working 1. Okay, so net asset we have got now, according to working 2, 138,000. Goodwill is 30,000. This one is 48,400. You deduct it. 119,600 deduct from 200,000 will give you 80,400. So this is the profit on disposal. This 80,400 you go and apply here. Profit on disposal. Okay. Now, from your investment income, you have to deduct your when you're taking for this thing, okay, NCI, you are deducting the dividend 30% of the NCI. But out of this 10,000 dividend, you have to take 70% and deduct it from investment income. Okay, the parents for Nepal. So that's why when you're taking this 8,000, you are adding, sorry, you're not adding, you're deducting. In fact, from this 8,000, the dividend was 10,000, only the parents percentage, 70% you have to deduct from 8,000. This is the Nepal's, okay, for investment income. Okay, so that's how you take, and it will be 1,000. Okay, so now profit before tax will be 209,400. Please check yourself, are you getting this figure? Don't just blindly follow me, you need to get this answer. The answers are there even in the textbook, you will get it behind. Okay, so profit for the period will be 162,400. This 162,400 already we have done profit attributable to NCI, which is 5,400. So the balance out of this 162,400, 5,400 goes here. Balance will be 157,000, which is for the equity holders. Okay, so part A is done. Now we are moving on to part B. Okay, part B, what should you do in part B? Remember, it's a discontinued operation, so you cannot consolidate. You understanding? So now what do you do? You just take Kathmandu groups, okay, because it's a discontinued operation. So I will highlight it for you. You just take this revenue and deduct this operating cost, you will get this operating profit. This is for part B I'm talking about. Okay, I will highlight it for you. Part B. I'm not rewriting it again and wasting time. I'm just showing you 103 will be operating profit. From here your investment income will be 1000. Just this one. This 1000. Okay, I'll write it 1000 for you here. Okay. Remember, the investment income when you're writing, you have to deduct the 70% of 10,000 from this 8,000. Okay. That has to be done. Because you have paid the dividend in cash, so you have to deduct it from investment income. Why do I deduct it from investment income? Because there is no other income to deduct your cost. Okay, that is the only place where you can deduct your dividend payment, the investment income. So you have to deduct it. This is not consolidation, but you have to deduct it. Because this is for the parent's point of view we are showing. So 70% is the parent, which is Kathmandu Group. So you have to deduct 70% of that 10,000, the dividend, from 8,000. Then you are left with 104. Profit before tax will be 104,000. Tax is 40,000. And you are left with profit for the period 64,000. This is, you have to write profit for the period from continuing operation. Okay, next. What's next? Profit from discontinued operation. You have to add one more line. Profit from discontinued operation. This is what I wanted to show when it is according to IFRS 5. That's it. How much? Nepal's profit was here 36,000. This you have to take 6 months, which is 18,000. And then profit on disposal. Already you have done it in working one. You have to add it. Add the two. What is it? 36,000 profit takes 6 months, which is 18,000. With that, add profit from disposal. Already in working one we have done it when we did part A. Use it for part B, 80,400. Do not recalculate and waste time again. 80,400. So it will be 98,400. When you show it, it's 162,400. The total profit. Isn't it same as this one? Part A, you see? I will highlight it for you. You see, here it is 162,400. Even here it was 162,400. So it's the same for part A and B. It's just the way you present it is different. Here you do not consolidate. You just write profit from discontinued operation as a single line item. You only take the parents. That's the only difference. Now, even profit attributable will be same. Okay, it will be this and this because this is same. There's no change in that. Okay. Now we are moving on to part C, which is a partial disposal. Okay. Before that, let me show you one difference. You see, after profit before tax, post-tax results, you show this as one line item, this part. This is one line item. You do not consolidate line by line like that. This is the difference with this way of presenting it compared to first way. So first and second both are same, but the way they are presented are different. Okay, in the first you consolidated line by line. Here you don't consolidate. You just put it as one line figure. Okay, now part C. Part C will be a little different because it's partial disposal. Okay, so here again you have to consolidate. Okay, so just a minute. Now you have to find the profit attributable to part C. So we have to do another working for part C, which is working 6. Why? Because when you are doing it partially, the profit will be different. So profit on part disposal. I'll first finish the working because this is only one working that is required. But remember, even this working, you need the previous workings, working 2, 3, and 4, the help of it. So since I have the answer with me already, I don't have to redo it again. Proceed. Okay. You sold it for 100,000. I've already highlighted here. You'll be having a fair value of retained interest. RI. Already they have given 100,000. 200,000. Where did they give you this? It's very important to find the place. This one. They have sold it for 100 and fair value is 100,000. Both are 100,000. And the good thing is when I'm finding net assets, NCI, goodwill, I don't have to redo it again. Already I've done it for part A. So answers are there. I will use it here simply. Net asset, goodwill, NCI. Working 2, 3, and 4. So this remains 138,000. This remains 30,000. This remains 48,400. 119,600. 80,400. I think it's the same profit. But now, okay, we have to show it. We have to consolidate. So when we are consolidating, same way how we have done for part A, 553 plus 6 months of 450,000, which is 778. Next will be 650, then 120, then 1000. Except what? Now you will have an income from associate as well. Okay, because now you're an associate. It's a partial disposal. So you have to add one more line, which is income from associate before profit on disposal. Okay, I'll write it here somewhere. Income from associate. How much? Remaining 6 months it's an associate and 35%. So 35% into what is the profit of Nepal? 36,000. Only for 6 months it was an associate, and 35% because associate's percentage is 35. So 6,300. So this 6,300 you need to add here with the previous figure. And this profit becomes, this is 80, this becomes 215,700. Okay, and this is 47,000 only tax. Profit becomes 168,700. Okay, this remains 5,400, but this balancing figure will change to 163,300. That's the change. You see? So that's it. Now we'll be moving on to control scenarios. Now, control scenarios. Okay, so the first here, some share purchase will simply just increase your entity's holding. It will not give you any control. You are already having a control. Now it's just your percentage is increasing. For example, before you have 80, now it's 85%. So this is not losing, this is not having any control. Okay, same way when you are selling, when you become from 80 to 75, you are not losing any control. That is known as control to control. Okay, when you're having control to control, the way you account is different. Whereas when you're losing or gaining control, we just saw how the scenarios work. Let's say it increased from 80 to 85. Okay, this is not even treated as an accusation in the group accounting. Okay, here NCI decreases from 20 to 15%. because at 80 NCI is 20, at 85 NCI is 15%. So accounting treatment is like this. NCI within equity decreases, okay, and the difference between the consideration paid for the equity shares and the decrease in the NCI is accounted for within equity. This is how you account for it. Okay, there is no profit or loss. Please understand, whenever it's control to control, there is no profit or loss. You don't calculate profit and loss. Profit and loss is only calculated when you are gaining control or losing control, not in this scenario. And also goodwill is not recalculated. Goodwill is only calculated the first time when you're having control. Second time, again, when percentage is increased, you're not calculating goodwill. Okay, this is the pro forma. You need to memorize this pro forma. Okay, you are basically adjusting the NCI. So cash paid, decrease in NCI, you deduct. Cash paid, obviously, to buy, you have to pay cash. And from there, you're decreasing your NCI. Okay, and that decrease or increase goes to other components of equity. Okay, if it's a decrease, debit balance. If it's an increase, credit balance. Okay. Now, the decrease in NCI, this is a fraction, okay? Decrease in NCI will represent the proportionate reduction in the carrying amount of the NCI at the date of the group's additional purchase of shares. That means how much you are reducing, how much NCI is reduced as a percentage. Okay, for example, if NCI shareholders reduces from 30 to 20, carrying amount of the NCI must be reduced by 1/3. Why 1/3? What is the difference between 30 and 20? 10%. 10 over 30, 10 over the previous percentage. 10 over 30, so that means 10 over 30 means 1/3. Understanding? So always is the difference between the previous and the old NCI divided by the old NCI. This is how you find the fraction. Okay. Now let's do a question. Test your understanding 5. Okay. So here you have two scenarios where NCI is reduced. In one, so you are owning 80%. In one, first scenario, you could buy 20%. That means having entirely 100%. If you're having entirely 100%, there is no NCI. Okay, for 25,000. So you're buying for 25,000. Second, you could buy 5% for 4,000, leaving an NCI at 15%. Why? Because at 80, NCI is 20%. And 8, and if you're buying 5% more means 85%. At 85%, NCI will be 15%. Okay, so carrying amount is 20,000. Okay, net asset is 125, goodwill is 25,000. Now you need to calculate. The word is calculate, so no explanation is needed. Okay, and adjustments required to NCI and other components of equity. This is a very simple, straightforward question. You just apply the formula, that's it. Okay, so let's do that. In first part, okay, so the formula is cash paid. How much? 25,000. Cash paid is a credit entry. Then decrease in NCI, obviously, because it's purchase. When you're acquiring, it's a decrease in NCI. How much? You are buying more? 20%. It's 20 over 20. Okay, 20% over 20%, because you are buying entirely 100% means there is no NCI. So it will be full. 20 and 20 on carrying amount. NCI of Menti currently has a carrying amount of 20,000. That means your NCI will change, okay, on 20,000. Carrying amount of NCI will change. That is what you have to adjust. So 20% on 20% into 20,000, which will be nothing but 20,000. Same figure you will get. Deduct this. And 5,000. Because it's a positive figure, that means your cash paid is more than your decrease in NCI. It's a decrease in other components of equity. I'll show an arrow downwards. Other components of equity. OCA. Other components of equity, or OCOE. Okay, OCA is better. Other components of equity. This is a debit balance, okay, decrease in NCI. And here, because it's a decrease in OCE, it's a debit balance. Coming to the second part. Second part is again the same, only the figure changed. Cash paid is 5,000 here, and it's a credit balance. Sorry, it's a 4,000 because they told for 4,000. Decrease in NCI is the same, but here, remember, you are buying 5% more. So that means NCI will decrease 5% more. NCI was 20, now it's 15. So the difference is 5%. Always the difference is the numerator. Denominator is the previous NCI. That is at 80% NCI was 20%. So 5% over 20% into the carrying amount, which is 20,000. Carrying amount of NCI. So which is 5,000. This time you see cash paid is less and decrease in NCI is more. It's a negative balance of 1,000. So this is a credit balance. It's an increase in NCI. Increase in other components of equity. And this is a debit balance because decrease in NCI. That's it. Now it is the opposite. Sale of shares without losing control from 80 to 75. Here NCI will increase from 20 to 25. Accounting treatment is similar. Here within equity NCI will increase. Now it's the difference between the proceeds received and the increase in NCI. It's similar. This time it's a cash proceed received, so it's a debit balance. And increase in NCI will be deducted. It's a credit balance. And then if it's an increase in other components of equity, it's a credit balance. And if it's a decrease, it's a debit balance. Always remember, increase in other components of equity is a credit balance. Decrease is a debit balance. Okay. So here, increase in NCI. Okay. Always. Okay. Increase the increase in the NCI will be the share of the net asset always. And the goodwill of the subsidiary at the date of the disposal which the parent has effectively sold to the NCI. Okay. So if it's the goodwill, the fair value method, remember, only the fair value method has both the part, one for NCI, one for the parent. So if you are having a goodwill fair value method, okay, at the date of disposal, what happens? Parent is selling it to the NCI. You understanding? That's why an increase in NCI will always be share of net asset. Because it is parent is selling to NCI. Okay. Only it's a fair value method has been applied when you're calculating goodwill. Okay. For example, if NCI increases from 20 to 30, carrying amount of NCI must be increased by 10% of the subsidiary's net assets. And if using the fair value method, goodwill. Now let's do questions on this one. Illustration 5. So there are 3 questions which we are going to do. Illustration 5, test understanding 6 and 7. Okay. Here in illustration 5, you are supposed to discuss the treatment of the above. So the word is discuss. Whenever the word discuss says, you need to calculate, but calculation mark is only a little portion. More is on the discussion. Okay, basically you're discussing the numbers that you are going to get. So here they hold 90% until 30th September. And then on that date they have sold 10% interest. So it became 80%. That means there is no loss of control. 90 becomes 80. Okay. Interest in equity capital is this much, 15,000. And net asset and goodwill on the date of disposal is 100,000 and 20,000. NCA was valued at fair value. Okay. So now let us do this. What happened here? Simply the NCI increased. Okay, from 10 to 20. Okay, so we'll do this. So basically the explanation part, you can do it, you can write it. You have seen lots of questions till now. I'm just going to do the calculation straight away. Okay, but you have to write that shareholding decreased from 90 to 80, NCA increased by 10%, and they still have a control. Okay, and also you have to write that there's no gain or loss that will be calculated. Okay, and goodwill is also not recalculated. All these points you have to write. Okay. Okay, maybe I'll write it in a bullet points for you. Maybe that will help you. Yeah, I think that's better. Since this is the first question, I'll write the points. Hereafter, if a similar question is repeated, you can write the points. Okay, let's do that. So, this is for illustration 5. Okay, first point is shareholding decreased. Okay, start with the most obvious. Shareholding decreased from 90 to 80. 90% to 80%. Then what happens? Still, Juno still has a control. Okay, Juno still controls over its subsidiary. Okay, Juno still controls Hera, and Hera is still a subsidiary. It's very important for consolidation purpose. You have to write it. What's next? No gain or loss on the sale. No gain or loss is calculated because this is simply the transaction between equity holders. There is no gain or loss. Okay, goodwill is not recalculated. Then what's L? Instead transaction. Okay, instead this transaction, this is accounted. Okay, this transaction is accounted for in equity. Whenever a question like this comes, you have to write these points. Okay, as an increase in NCI. Okay, now so you have to write. When you're writing, remember, even what you do, the calculations that you do, you have to explain in words. I think the wording part you can do it. Let me show you the calculation. So it's the cash proceed. How much is the cash? You sold it for 15,000. Okay, this is you sold, so it's a debit. You're receiving cash. Increase in NCI. How much? You have to take 10% because NCI changes 10% from 10 to 20. Okay, then you have to add your net assets and goodwill. Remember, when it's increase in NCI for the disposal part, when you're taking the NCI, that percentage is on the net asset plus goodwill. Always on this you have to apply the NCI percentage. So net asset is 100,000, goodwill is 20,000. Just in the previous slide we saw that. It's always. So 100,000 net asset plus 20,000 goodwill. On that you apply 10%, which is 12,000. This is a credit balance. Okay, and now you are left with 3,000. This is a credit balance. It's an increase in other components of equity. So you can write in words that NCI is increased by 12,000. The difference between sale proceed and increase in NCI is 3,000, and this will be recognized as an increase to equity. All these things you can write. Now let us go to the next question. Test your understanding 6. Here also the word is discuss how the share sale will be accounted for. Okay, so here they have owned 90%. Okay, and they sold 5%. That means it becomes 85% now. For how much? For 5,000 they have sold. Net asset is 70,000, goodwill is 20,000. NCI is at fair value. This is similar to the previous one, isn't it? So I think now with this previous understanding, quickly you'll be able to do. So explanation part I'm not doing. Okay, same things you have to explain. That goodwill should not be calculated. Then no gain or loss. Okay, still control is there. It's a subsidiary. All those things you have to write, but we'll calculate. Okay, so cash proceed is how much? 5,000. Debit. Increase in NCI. How much? 5%. Of what? Net asset and goodwill. Net asset 70,000, goodwill is 20,000. You have been given the figure. So 4,500. It's a credit balance. And you're left with 500. This is a credit increase in other comprehensive other components of equity. Whenever it's a positive balance for disposal, remember it's a credit. And for a transaction, for a purchase, for an acquisition, negative balance is credit. Okay, this you need to understand very carefully. Okay, so this is what basically you are going to explain. Similar like illustration 5. Now let us go to test understanding 7. Okay, here you have to do a bit more work. 3 companies are there. Okay, you have been given the assets, the equity part, ordinary share, retained earnings, liability. Okay, wait, Sprite and Tango. Okay, so investment in Sprite is a separate subheading, investment in Tango is a separate. What are you required? Discuss how to account for the purchase of additional 8% and the sale of 10% of Tango. So in one company you are buying, in the other one you are selling. Both together can come in one question. So we'll deal one company at a time. Rather than touching both Sprite and Tango, we'll go one by one. It's easier because it is separated from each other. So Pepsi acquired 80% of Sprite. That means it was a subsidiary at that time. Retained earning was 25,000. Cash consideration, they paid it for 300,000 to get it. Group policy NCI at fair value. Fair value is 65,000 of NCI. Additional 8%. That means it becomes 88, right? For cash consideration 26,000. So let's deal with the purchase. So discussion part you can write, okay, that if it's increased from 80 to 80%, it is still a subsidiary before and after the purchase. No gain and loss. Control is there. No goodwill has to be remeasured. Okay, transaction is accounted for decrease in NCI. So all these things you can write. You understanding? So now let's do the working. I will directly show you the working. Okay. So here, okay, wherever it is, okay, I'll write it as cash paid. This is for Sprite. Okay, you bought it for how much? 26,000. It's a credit balance because it's cash paid. Remember, which cash are you applying? You need to be very careful in this one. It is not the 300,000. It is this 26,000. For additional, how much you are paying? Okay, and when you are showing the decrease in NCI, you have to do a working here. For increase and decrease is a little different. Okay, decrease, I'm just showing by an arrow, okay, that it's a decrease in NCI. So how much? What is the additional? 8%. So it reduced by 8%. Over what? Before it was 80%. So at this, NCI was 20%. 8 and 20 into, okay, so for this, to find this carrying amount of net asset, you need a second working. Okay, you need working number 1. So we'll go to that working number 1 and we'll do NCI. You need the carrying amount of NCI. This is only for decrease, okay? So NCI at acquisition, they have given you the fair value already, 65,000. Okay, NCI post acquisition reserve. This simply you can do by the movement in the net asset. NCI before was 20%. That means at 80, not at 88, not after buying additional 8%. What is the NCI? No. This 20% is first time acquisition. Okay, 20%. You bought 80%. That time NCI was 20%. Okay, so the net asset. What was the net asset? They have not given here, but you can find from here. Okay. Just a minute. Okay, so here you see here you have to check the retained earnings, okay? Because the moment in the retained earnings, so retained earnings in Sprite was 100 in the reporting date, but at accusation it was 25,000. So the difference, okay? So 100 minus 25,000, okay? It will be 15,000, okay? So 65 and 15 becomes 80,000. This is the NCI before control to control adjustment. NCI before control to control adjustment. 80,000. This 80,000 only you have to apply here. I'll drop this. This comes as working one, okay? So 8 into 20 into that 80,000. This you don't have to do for an increase in NCI, only for decrease in NCI. So 32,000, okay? This is a debit balance. Then it's a positive because your positive is more. So 6,000 and this is a credit. So this is again an increase in other components of equity, OCE. Okay, basically that part you can explain. Now coming to sale of Tango. Okay, Tango. Let's go to Tango. Acquired 75%. That means it was a subsidiary at that time. Okay, retained earning was 60,000. Cash consideration you bought it, you acquired it for 200,000. Fair value was 50,000 of NCA. Okay, they sold 10%. Still they have the control. Okay, they sold it for 35,000. Now, so all those things you can explain, right? That decrease is not leading to a loss of control. Therefore, they are still subsidiary. No gain and loss. No goodwill will be calculated. Okay, transaction is increase in equity. NCI increases. All these things we are explaining in the same way. Okay, so immediately we'll go and do the workings. Cash received. How much? 35,000. You've sold it for 35,000. Increase in NCI. How much? 10%. Here that fraction does not come like how in the decrease in NCI it comes. Okay, it's only 10%. That means you sold 10%. So change is 10% into, remember, you have to add your net asset and goodwill. So your net asset and goodwill you have to calculate this time because it's not there. So for that we need a separate working. Working 2 and working 3. Okay, so we'll do that. Working 2 net asset. Okay, here this is how you do net asset. Okay, at accusation date, 2 columns I told you before, also reporting date. Reporting date, from the statement of financial position you will get. Accusation date, information is given. So only share capital and return earnings are there. If you see your see, this is how you decide. Okay, you have to go to your statement of financial position and see under equity only these 2 are there. So in your net asset only these 2 comes, ordinary share and return earnings, and there is nothing, no change in fair value or nothing like that. So just the share capital and retain earnings. So share capital remains same. It will be 100 and 100. This is for Tango we are talking about. Acquisition date also same. Reporting date also it will be same. There is no change. Only retain earnings changes. So retain earnings, if you see, it is 200. This is at reporting date. But here for Tango they have told that it was 60,000. Okay, this 60,000 is at the acquisition date. 60,000 and 200,000. Obviously at the reporting date return earnings will increase. That's how you're getting post acquisition profit, right? The moment. So here the total is 160,000. Here it is 300,000. Next we can calculate goodwill because we have the net asset now. We need goodwill and net asset because without that we cannot apply the increase in NCA percentage. So consideration. This is when you bought the subsidiary for the first time, 200,000. Then NCI is already given 50,000. Is the NCI given? Yeah, NCI is given 50,000. And net asset already we have just now got. Which net asset? This 16,000 will take at the 160,000, sorry, at the acquisition date, not the reporting date. So 90,000 is the goodwill. This is always fixed in this method. Okay. So now 300, but remember when you are applying it in the increase in NCI percentage, you have to take this 300,000, not the 160. This 160 you needed to calculate goodwill. Okay, so it will be 300,000. 300 plus what is the goodwill? 90,000, which is 39,000. If you apply 10% on it, this is a credit. Now 4,000. This is a negative balance and it's a debit. Decrease in other components of equity. Okay, you see, this is how you do it. Next, we have subsidiaries that are acquired with a view to resale. Okay, see, when you are having a subsidiary that you have acquired to resale, it is not excluded from consolidation. You have to still consolidate, right? So, if it meets the held for sale criteria according to which standard? IFRS 5, then this is how you have to deal with it. In your financial statements, it is presented as a disposal group that is classified as held for sale. Okay, so what do? You add amalgamate. That means you add up all your assets in one line and liabilities into another. Okay, then both on your acquisition and the reporting date, you have to measure it at what? Fair value less cost to sell, because this is now according to IFRS 5. Okay, we'll do a question after this. Next, so the held for sale criteria in IFRS 5 includes this requirements. 3 requirements are there. Number 1, subsidiary has to be available for immediate sale. If it is not, IFRS 5 is not satisfied. Second, sale is highly probable. Sale needs to be highly probable. How do you know all this? Information will be given to you, okay, in the exam to identify. Next, it is likely to be disposed within 1 year, within 12 months from the date of its acquisition. If these 3 conditions are there, then you can say it has satisfied held for sale. So it will follow the rule of IFRS 5. Okay, now let's do a question. So this question is about IFRS 5. Okay, Jackie meets the criteria to be classified as held for sale. Okay, now they have given you the assets and the liabilities and the selling cost. So basically the requirement says discuss how Jackie will be treated in the group financial statement. Okay, on 31st March liabilities was 40, asset was 180, expected cost to selling is 5 million. Okay, and on 30th September asset is 170, liability is 35, and selling cost again is at 5. Okay, so now on acquisition, first let's find, we have to value it at fair value less cost to sell. Remember, this is IFRS 5. Okay, so you have to value it according to fair value less cost to sell. Okay, you need to remember this. Sorry, cost to sell. So now first let's find out on 1st March what is the asset. Asset is 180. Deduct your selling cost is 5. So it becomes 175. From here you need to deduct your liabilities. Remember, when you are IFRS 5, you have to add all your assets and add all your liabilities and deduct your assets from liabilities. So here I'm going to deduct my liabilities for 1st March. Okay, 40, which is 135. Okay, 135 million. This is fair value less cost to sell. Now we'll keep it on this date. Remember, when you are on 30th September, you have to remeasure it again to fair value less cost to sell. So again, we'll put on here only asset on that date is 170, selling cost is 5, which is 165, and your asset now is 35, which is 130. So what happened? Can you see? There's a decrease by 5 million. You have to write this as well, okay? I'm just explaining you through figure, but explanation part is up to you. Okay, you'll be able to write it. So here it has decreased. This reduction, where will it be shown? This will go to P&L, direct in the P&L. Okay, and how will it be shown? As a single line item, it will be shown as a discontinued operation. Okay, as a single line, this 5 million will be shown. Loss or profit from discontinued operation. Okay, remember, even here, you will also include one thing. What is it? The post-tax profit or loss, whatever it is, up to the date, like from March to September. Okay, from March, because March was the date when you have acquired. And September it was classified as held for sale. So from March to September, whatever the profit is there, post-tax profit, you can include it there. Okay, post-tax profit. Now, in your statement of financial position, you need to discuss how this will be presented. So in your statement of financial position, how will you show it? Remember, assets and liabilities of Jackie should be shown separately from the other assets and liabilities because it's a discontinued operation. Okay, in your statement of financial position. So Jackie's assets will appear below the subtotal of current assets. Now it becomes a current asset because you are selling it within 12 months. So after the current assets total, you're writing this. What is it? NCA, non-current asset, held for sale. You're writing this after current assets total. How much? You see here, you have to check, take the September figure. Okay, 30th September, 165 asset minus selling cost, 165. So 165. Okay, this is in millions. In your statement of financial position, this is how you will show it. And what about liabilities? Liabilities also after current liabilities, you will write this item. Okay, under current liability, not under, after current liabilities. You will write this line. Liabilities. Okay, directly associated with non-current assets. With NCA classified as held for sale. Okay, it's the same thing you have to write again. How much? It is here. Go up here, 35. That 35 is your liability. You only deduct the selling cost from your assets, not your liability amount. Okay, 35. And no other disclosure is required, only this much. Okay, so now we'll move on to disposal of an associate. Disposal of an associate. All this while it was a disposal of a subsidiary. Subsidiary became an associate. Now, what if it's an associate that you're disposing? So this is how you have to treat. Investment in associate is de-recognized. Remember, anything you have disposed, de-recognize. Next, if the shares that are retained falls within the scope of IFRS 9, then you should recognize it at fair value. Okay. Next, profit and loss. Remember, loss of control. Okay. Even if it's a loss of an influence. Okay. If you're selling an associate also, you have to calculate a profit and loss on disposal. So a profit and loss on disposal will arise. Okay. And it will go to profit and loss. This is how you have to calculate. And remember, whenever they say they give you a pro forma, you need to memorize it. You need to memorize the pro forma and exactly apply it in your exam. Obviously, the numbers will be here and there. Some additional information will be there or some numbers will not be there. But you should know the basic pro forma. Okay, so you start with disposal proceed. It will be given to you. Next, fair value of retained interest. If you are not selling it entirely, some portion is there. You will have this fair value of retained interest. And mostly, it is a trade investment. That means it falls within IFRS 9 when you are disposing an associate. Then you add it and you deduct your carrying amount of the associate at disposal. That means you have to find out, you have to do a little bit of calculation here. How? The cost of associate, add the group's share of associate's profit, and if there is any cost and all, you deduct it. That's how you find associate at disposal. So you deduct it, and then you find the profit and loss to the group. Okay, now let's do a small question before we move on to the last section of this lecture, that is group reorganization. Test understanding 8 Raven. Okay, discuss the accounting treatment for 31st December 2002. The moment it says discuss, you need to write, but I'm going to just show you the number because explanation part I'm sure you'll be able to do it, but I will explain you also. Okay, you can write it. So here Raven purchased 25% ordinary shares. See, this is an associate, this is not a subsidiary even from the beginning. Now it was purchased for 1 million. That means associate initial cost was 1 million. Okay, retained earnings at that date was 3 million, and on this day 30th June they have sold 20%, so it becomes 5% now. 25 minus 20, for 2 million they have sold it. Now the retained balance is 3.8. Earlier it was 3. Okay, now that 5%, this 5% holding, okay, what is the fair value? 0.5 million on 30th June 2002, but on 31st December 2002 it increased to 0.6. So you can see there's a gain. But before we directly jump to that gain from 0.5 to 0.6, we need to go in steps order. What's happening here? First you need to explain by saying that this reduces significant influence. Okay, sale reduces significant influence, not control, because this is associate. Okay, less than 50%. Okay, so this sale reduces significant influence. You can even mention the percentage from 25% to 5%. Okay, or by 5%. Now, so it's no longer an associate, no longer an associate. Okay, if it's not an associate, then what is it? Okay, okay, before we come to that, so you have to de-recognize the associate de-recognize. All this must be there in your answer to get the full marks. Okay, associate de-recognize. Then next point, I'm writing it in point forms, but you have to write it in proper sentence in paragraphs. Okay, then let's talk about associate first. So initially it will be recognized at 1 million because you bought it for 1 million. Initial recognition of an associate. Remember, to de-recognize, you have to know the value at that date when you're disposing. What is the value of the associate? That's why we are first valuing the associate. Okay, because that amount only we can de-recognize. We just cannot de-recognize without finding the initial value. So initially it is 1 million. Okay, now you have to add the post share, the Swartz share of profit. Sorry, Raven would account for its share of associates profit. I'm sorry. So here with this 1 million, you have to add plus, what is it? Associate was 25%. How do you get the profit? See, profit is changing the retained earnings. Retained earnings, when you acquired it was 3 million. When you dispose it was 3.8. So change in retained earning is the post acquisition profit. So 3.8 minus 3. Okay, million. How much it will be? 1.2 million. Make sure that you get this 1.2 million on your calculator. You have to get it on your own. Don't just rely on my figure. Otherwise you will not learn it. Now you have to find a profit on disposal. You have to write this because you have to discuss as well as you have to calculate. The profit on disposal has to be recorded where? In profit and loss account. Please always write the place where you are recognizing it. Okay, so you start with disposal. Disposal proceed. You have sold it for how many? 2 million. Okay, dollar. Then Remember, you still have some retained there. So fair value of the retained investment, okay, or the fair value of shares retained, 0.5. And then carrying value of associate, which you are de-recognizing. How much? Just now we have got it 1.2. So 2 plus 0.5 minus 1.2 will give you 1.3 million. This is the profit on disposal that you need to recognize in P&L. Okay, that's not enough. Okay, what about that 5% holding? You have to then explain this. What about this 5% holding then? We are over with associate. We initially recognized it, then de-recognized it, then found the profit. But what about that 5% holding? Which standard are you applying it? This is a financial asset. Okay, it's a financial asset. Whenever something is remaining, there's a financial asset. 5%. So it will be recognized at what? At 0.5. In which, according to which standard? IFRS 9. According to the standard. Already they have given you the value 0.5 and 0.6. It increased to 0.6. So at this date, it will be recognized as 0.5. But by the reporting date, it went to 0.6. So there's a gain of 0.1. Can you see this? Where will this gain go? You have to write the place. This gain will go to P&L, profit and loss. But remember, this can also go to other comprehensive income, only under one condition. What is that condition? When the shares are not held for trading and an irrevocable designation has been made. Irrevocable designation means you have elected that you are going to pass it through OCI forever. Irrevocable, why? Irrevocable means you cannot reverse it. You cannot change the decision once it's made. But here, since no information has been given as such, it will go through profit and loss. But you can mention this also in your answer, that if the shares are not held for trading and irrevocable designation has been made, then it goes through OCI. Okay? Then the changes in the fair value OHA goes through OCI. So that's it. This is the last part of this lecture, which is group reorganization. Okay, assuming all subsidiaries are 100% owned. Okay, what happens? A group reorganization will have no impact. Please listen. Group reorganization will have no impact on the consolidated financial statements. Why? This is just assets and investments are moving in the group. They are moving within the group. They are just changing hands. That's it. There is no actual impact. That's what you need to remember. So let's finish this lecture with one single question before we summarize the whole IFRS 10. Test your understanding 9. Lethal. Okay. So here you have been given two companies. One is Rosa and the other one is Hans. They are dealing with two separate issues. Okay. Now you are required with, see, explain with calculations. Okay. How the transactions will be dealt in consolidated financial statement. So let's finish with Rosa first. Okay. They've purchased 85%. Okay. NCI was measured at fair value. And Lisa sold 5% for 9 million. So now from 85 it became 80%. Okay. Goodwill and net asset at that date was 8 million and 120. Okay. And cash has been given and profit and loss has been credited. Okay. So we don't have to read Hans. Hans is a separate person with separate issue. We'll first finish with the Rosa. Okay. So here what's happening? Here you can say this is control to control scenario. Okay. That means you don't have to calculate any profit and loss. So this is incorrect. Right? This is incorrect. You have to correct it now. There is no profit and loss on the sale. Because this is, you have not lost the control. Only your NCI will increase. increase. So it's an increase in NCI. Okay, that's what you have to talk about. Now let's do that. So first you start with the cash. Okay, cash is debit 9 because you have sold it for 9. So cash is debit, this is debit. This is correct. Okay, now with this you have to the increase in NCI. How many what's the percentage? 5%. When it's an increase, you have to take 5% of what? Goodwill and net asset. So add your goodwill and net asset, which is 8 and 120. 8 plus 120. So if you apply 5% into 8 plus 120, it will be 2.6. Okay, this is credit. Sorry, this is not 2.6, this is 6.4. I'm sorry, this is 6.4. The answer is 2.6. This is a credit balance because this is an increase in other components of equity. You see? So what's happening? Now correct the entry. So the correct entry will be, this was earlier it was credit, now it will be debit. So you debit P&L 9 million, and whereas do you debit? Now it's credit NCI and credit other components of OCE, other components of equity. How much? NCI will be 6.4 and OCE will be 2.6. Now when you're doing entries like this, be very careful. Your debit needs to be equal to your credit side always. If you add up this to credit side, it will be equal to 9 million, which is there on the debit side. Okay, now let us move to what? Hands. Okay, hands on the other hand purchased a 70%, that means it was a subsidiary, 405. Okay, at that date carrying amount of net asset was 100 million. Okay, this net asset had a fair value of non-depreciable land. Okay, carrying amount is 5 million, fair value is 15 million. This was not included there because they told with the exception. So you have to include it, you have to adjust it. Okay, NCI is 36 million. That is fair value. And on 1st of October, they sold 40%. 40% means from 70 to 40, it becomes an associate, 30%, right? For how much? 72 million. Cash receipt is recognized. Okay, now let us believe the remaining 30% is significant influence. Okay, and the fair value of this 30% is 51. Now you have been given some extracts: share capital, retained earnings, and profit. Okay, now you have to show them how to account for it. They don't know how to account for it in the consolidated. This is a long task to do. Okay, so you see they sold it on 1st of October 2001. When was it? From 1st of Jan. So from Jan to September, 9 months they had control. 9 months control was there. That means for 9 months they were a subsidiary. You can consolidate only 9 months figure, 9 months income and expense. This is the meaning of it, right? So what would be the impact on the consolidated profit? See, profit is 20. Okay, it is till 31st December. For 1 year they have given, you only have to take for 9 months. So 9 months into 20, which will be 15 million. This is the profit in the consolidated. This is the consolidated profit. Okay, and remember, out of this 15 million, how much did you acquire the first time? 70%. So 70%, which is 10.5. 10.5 million goes to parent. Okay, the balance, which is 15 minus 10.5, which is 4.5 million, goes to NCI. Okay, this you have to write also. I'm just showing you 3 numbers, but you have to write it also in sentences because they don't explain with calculations. Now, because they have sold, Remember, this sale is causing loss in control. You have to write these words. That means you cannot consolidate from from that date onwards. You have to calculate profit and loss. Okay, and you should write all these things, that you should de-recognize three things. What is it? Goodwill, net asset, and NCI. De-recognize it and recognize a loss or a profit instead. So let's see how this is calculated. Okay, sale proceed. You have sold it for how much? 72 million. Then we have something, right? Retain is the fair value of shares retained. They have given us 51. Now you have to deduct what? Net asset, goodwill, and NCI. All these three needs separate working. You have to calculate net asset, goodwill, and NCI. Okay, so let's do that first. Okay, what do we do first? We can find the net asset. Okay, so let's do the net asset. Working 1. Okay, working 1, working 2, working 3. Okay, so there are two things here. Share capital, this is for net asset. Okay, and retained earnings. Okay, which one you are taking? You need this, you need here. See, you need this 8 and you need this retained earnings 130 for net asset. Okay, so 8, 130. What else? Fair value adjustment. In your net asset, you have to take your fair value adjustment also. Fair value adjustment. What is that fair value adjustment? The land. I think they have given some non-depreciable something. Non-depreciable land. Carrying amount was 5, fair value is 15. So the difference, you have to increase it. Okay, it has been revalued. From 5, it has been revalued to 15. So the difference, which is 10. What's next? Profit to disposal. Once you have disposed, okay, remember this profit 20. Okay, you only have to take 9 months of it. This profit also will come there. This profit is till disposal date. That means only 9 months you can take. 9 months out of that 20. Okay, which is 15. So if you add all this, it's 163. Okay, this 163 you can go here and write 163. Coming to goodwill. For goodwill, you need what? Consideration. This is when you have bought it for the first time. You bought it for how much? 105. Then NCI. They have given you NCI acquisition already, fair value 36,000. 36 million, sorry. And net asset. Net asset. Remember this net asset, how do you get it? Fair value of net asset at acquisition. So this is how you get the net asset. Okay. At the acquisition, the carrying amount was 100 for net asset. With this, you add this also, increment of that land. The difference, I mean the revaluation you add. So it will be 100 plus 15 minus 5. That revaluation part you just add with your previous net asset, which is 110. And you get 31. So this 31 million is the goodwill. I will go to the goodwill and write 31. Okay, and now comes NCI. Working 3, NCI. So for working 3, okay, NCI at disposal we need. So first we have to start with NCI at accusation. Just now we got NCI at accusation. What is it? 36 they have given you. Then with it you add the NCI percentage of post accusation profit. So NCI you bought it for 70, that means NCI will be 30% into. See, they've already given you here. You see NCI at disposal just now we have calculated in working 160. I will highlight it for you. 163. This is at disposal. Okay. Then this net asset is at accusation. So you have to take this. The difference between this two is your post accusation profit. 163 minus 110. You will not get this in any question. Okay. I just wanted to show you how you can pick numbers and from which area. Okay. This is 110. So it will be 15.9. Add it and 51.9. This 51.9 you go and take it from here. Deduct it. Okay. So it becomes 142.1 you deduct. Okay. Then the total will be 19.1. This is a loss. Loss on disposal. It could be a loss. Right? So this is how you explain. Okay. You also have to say that after sale what happens. It's a associate. So associate, how do you account for it? You have to write that also. After sale it's an associate. Associate equity method you have to use. Right? So already they have given you the initial amount as 51. This is the amount of the retained interest, 51. With this you have to add leasehold's share of the associate's profit. Okay. How many months? Remember they were associate for the last 3 months. First 9 months they were subsidiary. So you have to take 3 months of the profit, which is 20. This 20 is what? The profit of this whole year profit for the year we are taking this 20 and taking 3 months of it. But with that you have to apply the associate's percentage. What is it? If you have acquired 70, okay, it will be 30% is the associate, which is 1.5 million. So with this you add, with 51 if you add 1.5 it becomes 52.1, 52.5. So this is the investment which goes in the statement of financial position as investment in associate, right, in the consolidated statement of financial position. Okay. In the profit and loss, what does in the profit and loss goes? Only this goes to profit and loss. Okay, the share of the profit. So all this you have to write, and with numbers you have to show. Okay, this type of question, before I end, we have finished this question. Just go through this type of question. This is very, very similar and very frequent in your SBR actual exam. You will always see this question: explain with calculation, discuss, explain with calculation, discuss. So you should be in a position to explain your figure. Okay, now let's summarize IFRS 10. So now let's summarize IFRS 10. Step accusation we started with. This means parent is gaining control in stages. Let's say first you bought 70%, then you bought another 10%. So at 70 also you were a subsidiary, and buying an additional 10%, that means 80, you are still a subsidiary. Okay. So in this, no profit and loss you calculate. It is just decrease in NCI, because this is step accusation. Next, yes, so exactly that's what I wrote. When you're acquiring control, you revalue your existing equity holding to fair value and you recognize a gain and a loss. Okay. Goodwill calculated as normal at the day the control is acquired. Remember, goodwill is only calculated the first time you have acquired the control, not the second time. Okay. And if you're losing control, then only gain and loss comes. Okay. Next, Acquisition of further shares after control is acquired are accounted for in equity. Goodwill is not remeasured. You do not remeasure the goodwill. It is just accounted for in equity. Okay. Now, for disposal, it is similar to it. Parent entity accounts gain. This is how they do it individually. Proceed minus cost. If it's in the consolidated, that means group accounts gain, this is how they do. No gain and loss, where no loss of control. If control is lost, this is how gain is calculated. Proceed. This time, fair value of any interest retained. Remember, if you have sold partially, some investment is remaining. That is valued at fair value. They will give you the fair value. So that also you have to add with the proceed. And if you are selling it 100%, you will not have that fair value of any retained interest. Okay, the thing will not be there, that line. Only when it's a partial disposal you'll have it. So net asset, and you have to de-recognize these things. What is it? Net asset at disposal, goodwill at disposal, and NCI. This is a pro forma. You need to memorize it, both in fact, because you don't know whether the exam will ask you parent entities accounts or group accounts. Mostly it is group, but they can ask both. Sometimes they might ask just the parent. So be very, very careful. Pay attention to each word in the question, whether it's individual or group. Coming to whole shareholding disposal. You consolidate to disposal and show group gain. Until the disposal you consolidate and you show the group gain. Then it is in the profit and loss. Gain goes in profit and loss. In your statement of financial position, subsidiaries net assets not included because entirely you are selling it. Next, no loss of control. You consolidate for full year because you're not losing control. And you calculate NCI pre and post disposal in profit and loss. In your statement of financial position, SFP stands for statement of financial position. PL is profit and loss, by the way. Okay, this is my short form that I've used. Consolidate in your statement of financial position, consolidate as normal with NCI based on year-end holding. Account for gain or loss to NCI in equity. We have done lots of questions on that. Then associate shareholding retained. Let's say whatever is retained is an associate. So in your profit and loss, till disposal you consolidate, then equity account show gain. Equity account because associate. In your statement of financial position, equity account at the year end based on the fair value of associate shareholding and disposal. Okay. Everything is at the year end when it comes to SFP. Trade investment. Let's say it's an IFRS 9, less than 20%. That is there. So still, till the date you consolidate, then include dividend income or show gain. Okay, in profit and loss. In your SFP, record the retained investment at fair value at disposal date. And where subsidiaries are acquired with a view to subsequent disposal, IFRS 5 rule applies. Lower of carrying value or fair value less cost to sell. You have to measure it at that. CV stands for carrying value. FV is fair value less cost, selling cost. Lower of this two. Because IFRS 5 says so. Okay. Okay. You must consolidate as a disposal group. Now, thanks for watching and don't forget to subscribe to my channel if you haven't. There's a whole playlist on SBR. Please go and check it. You will get all, and don't forget to watch part 1 of this if you have not watched part 1 of IFRS 10. And this video is definitely worthwhile watching, and it's very important that you do the questions from the revision kit. You have to pick the questions. There are plenty of questions in your revision kit that you need to pick and start doing right away for your June exam because it's not far away. And one more thing, that while you do questions, please note the areas where you are making the mistake. Which area? Are you not good at goodwill? Are you not good at calculating NCI? Are you struggling with net asset? Because the small areas will tell you where you need to pay your focus, where attention is required. Because so many things are required to do in for that 30 marks question. Trust me, consolidation looks very easy, but when it comes to the exam, it is one of the tricky area to gain marks. Why? Because marks are spread over so many areas, so many things to do, so many calculations at once, and students often start panicking. Okay, so you should not panic. Okay, Rather focus each small area, okay, and see how much time you are taking. Okay, so that's a piece of advice I would love to give for IFRS 10. And the next lecture is a small standard, IFRS 11, which is joint arrangements, joint venture, and that one. So see you in the next lecture, and thank you for watching. Take care.